Well, like I said, it's a recurring discussion, but I want to hear from you, your thoughts. How big is this problem? We know that a lot of Nigerian banks have been exposed to bonds 2009, 2010, when rates were really, really low. Now rates are shot up to 15, 16% across the curve, and now there is that risk that there might be some losses. But first of all, let's start from your assessment of how the banks have arranged these bonds in their portfolios and how big the problem is for earnings in particular.
Okay, if you look at September 2011 numbers, total bank or total issuance of government debt is about 5.3 trillion. We estimate that by the end of 2012, that could go to about 6 trillion because the central bank has said that they're going to issue, or the debt management office has said they're going to issue about 800 billion more. Banks typically hold about 60-70% of total government securities debt. The rest is in PFAs, insurance companies, etc. So let's just say the banking industry has about 4 billion, or 4 trillion rather, in these securities. And I think the real impact is going to be how banks classify them. You could put them in a trading book, a held to maturity, or an AFS book. The real impact is going to be, is there a loss in value of these government securities? Some numbers have been estimated at the central bank, within the industry, some potentially huge, some not so huge. I don't have the exact numbers, and I think those authorities are probably in a better space to say what the actual numbers are going to be.
Well, obviously, it will vary from institution to institution.
Yep.
But the issue now is, for those institutions that are exposed heavily, especially to the longer dated bonds, the impact that it might have on their P&L for 2012. Give us your thoughts on that.
Okay, again, everything depends on classification. If it's in a trading book, then it has a direct impact on your P&L, right? So it hits your P&L immediately. If it's in an AFS book, it has a direct impact on your capital. So it reduces your capital adequacy ratio, it reduces your ability to lend. So it depends on the classifications. If it's in a hold to maturity book, i.e. the bank has no intention of selling at any point in time, then those don't have any impact on either capital or profitability.
All right, let's look back, and some might accuse the banks of being reckless. Looking at where they're coming from, especially what happened in 2009, there was a lot of risk aversion, and it was a time when monetary policy was very loose, interest rates were very low, and at a time when banks were not really aggressive about lending, they went into government securities, and interestingly, it's these same government securities that are now threatening to bite them. Would you say they were reckless in their approach? I mean, what else could they have done?
I think our market is very well versed in credit risk. The bond market restarted in 2006 largely, and we're still learning. I think we're still trying to learn how to manage market risk. So I won't talk about that in particular. I think what's really important is how we're going to manage this risk going forward. There are a number of things that need to happen on multiple levels, right from regulators, auditors, risk management, board members, on how to manage market risk and especially interest rate risk from the bond market. So once that understanding is there, I don't expect this problem to repeat itself.
And then, of course, there's the whole issue of IFRS coming into play this year. How does that change the dynamic for most banks?
I think it changes it significantly across many levels. What IFRS tries to do is to make sure that you price assets or to recognize the price of assets against where the market price is. So if I buy a bond today at 7% and the market price moves to, or the yields move to 10%, then I immediately have a loss, which will either go to my P&L or will either go to my capital, depending on how it was classified. So once banks realize that the investment decisions that they take will have an immediate impact on their financial year position, same year, then they will look to quantify that risk correctly and manage it correctly going forward.
So all things considered, how do you see the yield curve evolving going forward? We know that right now, the shorter end, we're seeing a lot of high yields there, 15, 16, even 17% for some one-year paper. What are your thoughts on how the yield curve is going to move going forward?
I think a lot has to do with the way the budget is set. If the budget is set at, let's say, $70 to a barrel, I think the central bank already has limited scope to increase interest rates. And if the budget is set at the low end, then we're probably not going to see a spike in interest rates. What I think will now start getting into play is, one, is the currency getting stronger? Are we now going to start seeing international investors saying, the Nigeria story is very good. Exchange rates are stronger, they're stable, interest rates are very, very high. Let's start coming in, and we could have a repeat of 2008. However, if we see the benchmark oil price being set at the higher level, I think the central bank then has the leeway to say inflation is rising, the budget is very expansionary, then we have to react to it. However, whatever leeway they have, I still think is limited. Right, they probably can't do much more than this because it is expensive right now to borrow in the country.
All right, so everything depends on the oil price that is used for the budget. But final point from you, for an international investor looking at Nigeria's bond market today, looking across the African continent, how attractive would you say Nigerian bonds are?
I actually think it's very attractive. So the yield on the one-year Treasury bill right now...
Considering the currency risk?
Considering the currency risk, the yield on the one-year Treasury right now is about 20%. So in actual fact, you need a 20% loss in the value of the naira for you to be wiped out.
Which is highly unlikely.
Which we don't think is going to happen, right? And I think the currency is relatively stable. I think it's a fantastic play right now.
But why aren't we seeing those flows?
We've actually started seeing those flows. So we are having conversations where people are re-looking at Nigeria. We actually have done transactions where people are re-looking at Nigeria and entering Nigeria. We've not seen the volumes that we saw in 2008, right? But that will take some time. And I think by the time we have the economic story for the rest of the year settled, then you will start seeing a lot more volume.